Well, and parts of it have been much worse. Like, you know how I think the crypto market has taken it much worse than we expected.
Why?
I think part of it is that crypto industry doesn't have any leverage right now.
Tom Lee is basically saying the market hasn't broken. It's been distracted. And crypto took the biggest hit, not because the fundamentals failed, but because money rushed elsewhere. According to Tom, the crypto market suffered far more than expected after a major deleveraging event back in October. Since then, crypto has had very little leverage to push prices higher, even though the underlying fundamentals have actually improved. At the same time, gold and silver exploded higher at the start of the year. That surge created intense FOMO, pulling risk appetite away from crypto and into precious metals. In Tom's words, it became a vortex, sucking capital out of Bitcoin and crypto just when sentiment was already fragile. So what we're seeing is a price disconnect, not a fundamental collapse. What's interesting is that Tom doesn't see the broader economy as weak. In fact, he believes the economy is still in decent shape. The real problem? Uncertainty. Washington is increasingly picking winners and losers, and markets hate that. When policy becomes unpredictable, investors move defensively, and that's exactly what we're seeing now. From a bigger picture view, this feels less like the end of crypto and more like a pause before capital rotates back once fear fades. If this helped you see the market more clearly, like the video, comment your thoughts, and subscribe. We've got more powerful clips from Tom Lee's latest CNBC interview coming up next.
It sort of delevered in October, and now when we have gold and silver doing so well, especially at the start of the year, that created FOMO, and that was like a vortex sucking all risk appetite towards the precious metals trade. So I think crypto has suffered from that on a price basis at a time when the fundamentals have been good. You know, it's been a contrast. I think the broader economy is actually in good shape. So to me, the turmoil here is kind of what you said. There's a lot of uncertainty because of Washington picking winners and losers, and some of this could be the new Fed pick. But I'm also kind of heartened. I think gold and silver taking a breather is actually a good thing.
A breather. I mean, 80 on silver. That's not breathing yet. It's like I don't know what that is. You do point out that the consensus now is for the GOP to lose the House, and that is not necessarily a negative for the markets.
With the midterm election approaching, the current consensus is clear. The GOP is not expected to win. And historically, when U.S. elections take center stage, Bitcoin and crypto tend to struggle. Not because the story is broken, but because uncertainty freezes risk appetite. Look at the pattern. In the months leading up to major U.S. elections, Bitcoin has often pulled back hard. In 2016, BTC dropped nearly 30%, about 3 months before the vote. In 2020, it fell roughly 16% just 2 months out. Even earlier cycles like 2012 showed similar pre-election weakness. The question now is simple. Are more dips still ahead? But here's the twist most people miss. Once elections are over and uncertainty clears, Bitcoin has historically exploded higher. After the 2016 election, BTC surged more than 3,600% over the following year. After 2020, it rallied nearly 500%. The takeaway? Markets don't like uncertainty, but they love clarity, regardless of which party wins. Midterms tell a similar story. In both 2014 and 2018, Bitcoin fell sharply in the weeks after the results, dropping as much as 50 to 58% before eventually finding a bottom. Short-term pain, long-term opportunity. Now the big question is whether this cycle repeats. And that's where Tom Lee's insights become critical. Let's hear what he has to say next.
For the future, because it's already consensus.
Yeah, I think it's consensus. It might actually be a positive surprise if the GOP keeps the House.
If that were to happen.
If that were to happen, but that's a big if. I think one of the things that we're seeing, of course, this year is the White House is deliberately picking more winners and losers early, I think, because of the midterms. In other words, their agenda is front-end loaded. I think that has caused some turmoil in markets.
Even if it was Hassett, or I don't know who the markets would have liked, but you think no matter who it is, that the market tests the new chairman of the Fed when he's announced, or she is announced.
We saw that with Fed Chair Yellen and Fed Chair Powell, that in the early days, the market tests them, whether it's their resolve around policy or rates. So I think the confirmation process creates a little uncertainty. And then I think the first FOMC meeting. So I think that's why the middle of the year could be quite bumpy.
Then you point out some things maybe to keep everyone a little bit grounded. Stocks were up the first 5 days of this year. Stocks are up 1% in January this year. Since 1950, that's happened about half, a little bit less, 36 times of 76 years, and the S&P was up 18% on average after a start like that. But I thought you said it. Someone recently said they don't even pay attention. I guess it was David Bond said, don't even pay attention to what happens in January, that indicator doesn't work. It's like the Super Bowl indicator. It's had its time. And you think it does? Historically, this is important.
Yeah, it's very telling. I mean, there's 36 times when it happened just exactly as you described. 33 to 36 times the market was up. The average gain's 18%. If you look at the non-36 instances, the other 34 or so, the market on average is down 5% for the year. So it makes a huge difference to do well in the first week and the first month.
A lot of this, obviously, the giveth and taketh away. AI went almost not like gold and silver, but kind of, asymptotic in a lot of those stocks, trillions of dollars of valuation. So that's going to be tough. That could be a headwind. Is that just, regresses, or we use mean regression or reverse?
Yeah, mean reverts, yeah.
Which do you like better? Reverse?
I could see both working.
I know. All right, so that could be a problem. So crypto doesn't have leverage right now. Is it going to go to the levels that you have talked about in the past still, or let's say 75,000 for Bitcoin? Is that a place where people would say, okay, I'm ready to buy, or is 40,000 a place where people say, I'm ready to buy?
Okay, I'm going to say something that it sounds a little contrarian, but okay. Tom DeMark is our advisor at BitMine in terms of crypto. He's been since mid-November saying Bitcoin would go to 77 and Ethereum at 2,400. So he's been waiting for what he calls time and price to align. This weekend, he believes we reached that alignment. So all the pieces are in place for crypto to be bottoming right now because we're getting the level and enough time has passed. So I think as long as crypto fundamentals are good, which is the case, Ethereum active addresses is going parabolic right now, and activity. Part of it is, of course, Wall Street is building up digital assets and converging those businesses. If that's the case, then crypto prices should follow.